Happy Tax Day, everybody. Also, a happy Game of Thrones day or at least post Game of Thrones day for everybody who watches that show. Millions of you potentially out there who watch that show. The market seems to started the week with wondering whether or not this was a holiday today. Remember, this is a shortened week. We do have a holiday at the end of the week. I think a lot of people might have thought it was the beginning of the week. Not very much movement, not very much action, except for in one pocket. So we take a look at that pocket to see the significance of it and how to trade it. So let's go ahead and get started. Today is Monday, April the 15th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see it's a very small, so look at the range up here in the blue. Very, very small range today. Down less than 2 points. Very quiet day, even if we did have a move to the downside intraday and a rally back up to the upside, and got a lot of chatter in terms of how bearish early we were and how bullish we are at the end. And the reality is it wasn't either, right? We're just, when you put it in context, it's just another, it's a down day on an upward trend, and we continue to have a very strong upward trend because your intermediate lines up here above 90, the market sentiment lines up above 80. I mean, that's a bullish combination. Your near-term line's above 80. In fact, you almost had another quadruple cluster. The only thing missing is a momentum line. Of course, it's falling with the down day. The near-term line also, remember, is setting up the potential for a bearish divergence, since we're already up to higher highs up here with the corresponding lower highs on the blue line. So keep that in mind. Again, it's a sign of weakness, but it's not a sign of it's not a sign of like imminent reversal, right? It's just like a red flag, but all red flags point to this is, like I mentioned before, this lower low with a higher low on the intermediate line. That's a red flag, and that hasn't played out yet. We would expect it to, like it did over here, but it took another week, and other times it's taken a couple of weeks. So we're still a couple of weeks off of that. So we'll see. We're getting some signs of weakness here with the oversold near-term lines, the extreme lows of the momentum line, the divergent low on the intermediate line, the near-term divergence we're setting up here. So there's signs of weakness, but again, any weakness we do get, remember, a Fibonacci retracement down to 2775-ish would just get you down to these old high points, and it would just be a 23% retracement. So I mean, that's not that big of a move. It would be a relatively big move because it'd be over 100 points to the downside, and I'm sure there'll be a lot of articles about how we're headed towards recession. But the reality is it wouldn't even be a 23%. I mean, a 38%, which is the norm, right? So keep in mind, if we actually fell, what would be the norm for this? If we were to come down here to this 38% Fibonacci retracement by, what would that be? Beginning of May 7th, down at the bottom. If we were to get down to where these fans are meeting the retracement levels, that would be a sharp move. That would be over 200 points to the downside. So that would be well over, that would be over a 5% drop in a short amount of time. It would be very normal, right? It would just be a 38% retracement to the top of this retracement zone, to the top of it, without, and that would actually set us up for a nice, good rally. So either one, whether we come down to the 23% or the 38%, those will just be kind of normal pullbacks. They're only steep, only more than 5% because of how significantly high this rally is. 2940 is the high point there. The high today is 2910, so we're getting a little bit closer to these highs. In fact, like I mentioned before, I wouldn't be surprised if we don't get if we don't get a move like this, like we did back in 2016, where we were going up for so long, and then we finally broke through the new highs, but then we kind of lost that momentum and eventually pulled back, and we finally got that intermediate pullback. But we, it took so long to get there. Such a rally to get there off of the, over here, off of the death cross pullback that we had in early 216. So we got up there and we were messing around. We finally got through, and then we lost that momentum, and there's our pullback, right? Ended up actually with a bullish cluster that was very, very bullish. That led to a nice intermediate run, new intermediate runs. This would be the first one, then you got the second one and the third one, and then the fourth one that was a 5-month long rally. So this right here, without being a log scale here, let's put it on a log scale. Right here, use log scale, see if it, okay, good. So this right here is looking very similar to this right here, where we were getting back up to these old highs, and we kind of meandered around without a significant pullback and broke through, and then we got the dark pink shading with the red lines here. So we'll see if that ends up being the case again. That would mean that we might have another month or two where we don't really go up or down as we fiddle around this area before we finally punch through. Who knows, right? We might punch through earlier than that, but once we do punch through, then you can see how we kind of lose that momentum. This is a long time, and this was months, and then that's the pre-election, November election of 16 clusters that, like I said, led to 3 more intermediate rallies during this market sentiment run. In fact, that was such a long time of sideways action that it actually brought the market sentiment line down below 52. Let's take a look now at the S&P, and you can see the S&P had a little bit more of a pullback on the near-term line. In fact, the Russell 2000 had the most. In fact, it dropped into the reversal zone. The near-term line's pulling back more than any of the others. It's a little bit more of a pullback in small caps, which is what you expect. But as you can see on the chart, nothing too significant here. But you can see the weakness, right? You can see the bearish divergence, and we'll watch that near-term line. And see if that turns out. As of right now, this is a bullish pattern. It would be more bullish if the near-term line was below 50, but considering we were just barely below 50, there's still a good chance we can bounce off of this and maintain a near-term run of 7 to 12 days, which is that typical time frame. Alright, before we look at some other charts, a reminder, subscribe to our YouTube channel. There's a YouTube logo, or excuse me, our Market Scholars logo right here. A mouse over that logo, click, red subscribe button will pop out. Click that subscribe button. You can also see a red subscribe button down below the video. Click on that. That's how you get notified when these videos are posted on YouTube. Also, while you're down there, click the thumbs up icon. That lets us know 2 things. Number 1, you got something out of the video. Also, number 2, you want us to do the video again tomorrow. So it's a quick way to give us quick feedback since we don't send out surveys to you. And number 3, comment down below on anything that stood out to you. What did you get out of the video today? We'd love to see what stood out to you or what you got out of it. Join our daily Market Outlook email list. There's a link popping out in the top right corner of your screen. There's a very, very easy way to subscribe there. Follow us on Twitter for more content in between videos, and then join our Market Outlook community that we created on Facebook. Remember, you can also subscribe to our email list down below. If you're watching a video on our blog, just scroll down here, sign up for our email right there, first name, last name, email address, and click on sign up. Very easy way to do that. Also, while you're here, 3 clicks we look for. Number 1, click on this heart that opens up today's Market Outlook tweet. Click on that like button. Number 2, click on this Facebook image. Takes you to today's Market Outlook Facebook post, where you can like and share there as well with other people you think might be interested in it. And number 3, click on this. This gets you points in our community. Remember, you can join our community right here in the top right. Just click on the subscribe button, and you can participate in our Market Outlook forums and see other people who are very active in the forums by things like that, by clicking on the like button and replying and creating threads and things like that. Alright, back to the long-term chart. Let's take a look, back to the charts here. Let's take a look at the long-term chart. You can see very small range, one day, and it was a very small range today. The range last week was also really small compared to what we've seen. Remember, unless we really came down, we had a really bullish candle here. But if you see that, depending upon where we finish, you can see today's open. Let's go to SPY here. The open for today's candle is a 286.08. Just to kind of show you some perspective on that. 286.08. Let's move this up here to 286.08. Okay, so that's where this week's open is. if I were to go back to that candle and to see it, if we end up with a really small range this week, let's go back to Heikin Ashi. Next week, as of right now, because remember the close is an average of this week's open, high, low, and closing prices, so that can change. The close will change. The open will stay at 286. Excuse me, yeah, 280. With this on SPX 2866.85. That will stay, but the close of 29.05 will change. So, but as of right now, if you take a look at where, and let's just go to SPY so we can see it on the chart. If I were to move this over here, then the close now is at 289.91, 289.91, and then the open is at 286.08. Divide that by 2, add that to 286.08. So next week's open will be at 287.99, and just to show you where that's at compared to where we're at right now, 287.99 is right there. So that's how much it will move up, barring any significant changes in that closing price by the end of the week. So we're starting to get, unless we continue to really push higher on these highs, and you can see the lows are going to be there for another week, then they'll start to move up. But right now we got about a 13-point difference on there, so we're really close to a 5%. So it's hard to really stretch that rubber band when you're on a bullish move too much further past that 5%. It gets bigger when you got higher volatility levels at the bottom end of moves, but not at the top end of moves. It's with low volatility, it's hard to really stretch that rubber band, and 5% seems to be a limit, and that's about where we're at right now. So, which means that we'll start tightening up here, and we'll start getting these on these weekly candles, these transition candles where you get highs and lows. Probably not this week unless we get some news out this week from these earnings releases, but probably not going to get that transition candle, which will have a lower shadow, would have to trade below that low point there. In that case would be a 40-point drop, considering how there's no ranges right now. Probably not going to get there this week, but next week as that open moves up, then there'll be a much better chance. Considering if we don't push up too much further to the upside, you'll start to get more of a chance of these kind of candles, which, they weren't transitions in this period, but the longer this runs, and we're now, 14 weeks with this bullish rally, then eventually you get that transition candle that moves to the downside, especially as we start to get more and more higher and higher above that 200-day moving average. All right, now let's move over to the 3 green arrow chart. Of course, 3 green arrows, and we still don't have that red arrow yet on the MACD. That's usually the first red arrow you get, because you start to lose momentum, and we start to fall below that 8-day moving average. And the red arrow actually comes when the MACD falls below its moving average, which is really close. So, and the stochastics already has fallen below its moving average. That's not what produces its arrow. Its arrow comes when it falls out of this upper quintile. Remember, this blue line is an average of the last 5 days closes, and where that average price of the last 5-day closes falls within the 14-day range, according to the numbers over here. So you can look at different numbers there, but that's the one that we use that corresponds to these other indicators that we use. So right now, that's a really bullish close. We've had really bullish closes. We're closing pretty much at the highs of whatever range we're looking at. It's very bullish. Until you stop doing that, that's when you get the red arrow, when you start trading lower. But you can see we're above the 8-day moving average. The 8-day moving average is nice and far above the 30-day moving average. In fact, if you go down here to the MACD, down here, and you say, okay, how far is that 8-day up above the 30-day moving average? And we use the exponential there. And you can see, that's, we're pretty high, relatively speaking. I mean, on the bullish move up, this is about where we were, and we got a little bit further up there, but we're relative to where we've been in the past. Look at this. Relative to where we've been in the past, we're higher now than we were at all during this bullish period. So we have very, very strong momentum right now, which is what that's saying. And until you break down below that red line or orange line and get that cluster, and it gets that red arrow, excuse me, that's the first one. That's kind of your first sign of weakness, which right now we just don't have yet. And it doesn't mean that we're going to get it. I mean, we can continue like you saw here, just to kind of slowly move our way higher. And even over here in some of these areas, you'll start to test the 17-day moving average, but you'll still easily stay above the 30 and not get that red arrow on the moving average for quite a while. All right, now let's take a look at the intraday charts. And again, you can see how we kind of took a step up on Friday and we stayed there. So not, it's again, like I said, it's hard to stretch that rubber band too far, and we've really got it stretched now, to that 5% at least of the low point, and we can go up to 5% of the high point, which is about another point higher or two. So kind of, there is some potential for a little bit more, but until this starts to move up, it's going to be hard for this to get going too far to the upside, which, again, slow and grinding doesn't, that's how you can still stay above that 8-day moving average. But if you look at the volume today and the trading range, this is why it's so hard to trade like bullish option, directionally bullish option strategies, because unless there's an event that causes a big move in a short amount of time, you can see that look how we're just grinding, and the range today was 1.28 points, well below the average, which is already really low. And then the volume at 49 million, well below its average, which is also very low. In fact, the average here, you can see, well, let's go over here. So 49 million, you can see, is off the charts in terms of where the average has been over the past year, and the average itself is relatively low to where it's been in the past year. The ATR is very low, 1.28 is also below the charts of where the average, the ATR, has been over the past year. And it's getting down to those levels too, and so is the relative ATR. So we're entrenched in this slow bullish grind right now to the upside. And if you take a look at the volatility index, we didn't, we're not grinding too far. We got below 12, and we're still, we got 212. We're still trading right around 12. And we did get into the lower half of the chart, took a little bit of a bounce up, and we're still kind of trading there. So we'll see, if we can get down in here and stay in here. That's a sign. That's a sign that this bullish trend is now. We might have another couple of months here, which would really be scary, because then that would give us 5 months of this intermediate run. And the last time we had a 5-month intermediate run was the beginning of last year, when we had a pretty steep sell-off. So we don't like those, right? We want nice and steady. Usually, though, like in the last pullback that we had coming off of that last year, that February-March decline, once we did break to the 85, it was quick, and that caused a jump in volatility, our intermediate pullback of last summer. Then it broke down into the lower half, and then you had some good bullish trading in the upper half and the lower half, and we were flirting with extreme lows there. So I don't think we'll be flirting with extreme lows until we have more of an intermediate pullback that brings this volatility, relative volatility level back up through here, and hitting this 100% area as a resistance level. All right, so before we talk about what's driving the action today, what action we did have, and then look at our trade example for the day, I want to vote. Let's see your vote on today's market outlook. What do you think about what we just discussed? Are you on that same page? Do you see something else? Click that link that's popping up there. It opens up a poll, then hit either agree or disagree. If you click disagree, scroll to the comment section below. Let us know what you're seeing that would suggest otherwise from what we came up with here with our outlook routine today. All right, now let's take a look at what's driving that price action. And you can see we were so bullish on these risk asset classes. That's kind of why we're slowing down, because now they're starting to pull back. This is a 2-week chart. And how bullish they were, how bullish bonds were. Now bonds have kind of flattened out on their pullback here, and crude oil is now pulling back, and so emerging market stocks are pulling back. S&P is grinding higher a little bit, but you can see what's weighing it down is a little bit of a pullback in risk appetite. You can see gold is also during this little run pulled back. So you can see also that we're not really increasing in risk aversion either. Otherwise, bonds would start moving up, and the dollar would start moving up, and gold would start moving up, and they're not yet. You can see high yield bonds and preferred stocks are kind of matching each other's returns. So it's interesting to see that. And agricultural commodities are also staying pretty strong, which is a reflection of trade deal attitudes right now with the U.S. and China, that being a big influence on where those agricultural commodity prices are moving. But other than that, you can see developed markets and emerging markets pulling back to developed markets, small cap stocks pulling back to large cap stocks, crude oil pulling back, and so that's what we're getting. I mean, there's no, down. We're going to have a lot of earnings this week, but from a broad market sense, we've been bullish. We've been bullish for a while, even on a short-term run, and now we're kind of easing. And you can see it's not a easing towards risk aversion. It's just a little bit of a easing on and a sideways action on that risk appetite on these bullish asset classes. You look at the foreign markets and how they perform today. Kind of your smaller cap emerging markets, so to speak. Indonesia, Argentina. You can see Brazil bouncing up as well. India up there, and on the other end of the spectrum, China was down today, and then Mexico here, as well as Turkey and Thailand. So you had some emerging markets on the top end, you have some emerging markets on the downward end, and everybody else about as flat as a pancake. The only significant news on the calendar today was the Empire State Manufacturing, which bounced up again. It's kind of had this low number and then a little bounce, and low number and a little bounce. But you can see the trend. We haven't kind of broken this trend yet of this decline since that August peak that we've had on a lot of these indicators. You can see the economic surprise index has been updated now through today, and it's still very low. So it's hard to get interest rates to go too much higher when there's no odds for rate hikes, even though the odds of holding steady are rising. Look at the, you can see, it won't have today's, but you can see how the odds of holding steady are moving up to 60%, coming off a really low level. So that's a positive. But the rate hike odds, which would be this red line, this one here, the darker one, not this orange line, but this darker one, you notice has not jumped up at all. So you'll see a little bit of a bounce in yields because of that, because the odds of a rate cut are dropping, but they're not going to bounce up to new bullish trend because the odds of a rate hike aren't rising, and they're not rising because there's no need to. The economic indicators remain weak. They're not bouncing up, as you can see here, and the trends that we see in a lot of these indicators are still to the downside. There is one sector that's had a really good bounce here, because of earnings here on Friday, and this had a pretty decent run even before that because of this bounce in yields, kind of matching the return to these cyclical areas, technology, communication services. You also see consumer discretionary, and then you have other kind of dollar sensitive areas. Materials are up there, but the industrials and energy, you can see energy now starting to lag behind, and all your safe haven areas, including healthcare, really struggling as we've kind of focused on that here recently. But I want to look at this energy sector for today's trade example, as it's starting to show a little bit of relative weakness here. And you remember from the sector selector rankings, energy is still remains, and I've got this grid here with the sector selector rankings. Energy remains the weakest sector here. So it's not really, it's got the falling movie. It's pink now. It's a very, very weak bearish, and doesn't have the red line. So it's just weakness. It's not a bearish trend. But you notice healthcare does have that. We do have the strong bearish posture below 50. It's falling, and we have a falling red line. So healthcare is showing a very bearish pattern here, and everything else is bullish except for energy, which is showing the only one that's showing some weakness. All right, so our trade I want to take a look at is Occidental Petroleum in that sector, and you can see the downward decline it's had. It doesn't have the dark pink line yet, shading yet, because we're not below 50, but that will probably be there tomorrow. We already have the red line on the moving average because we're below a falling moving average, a good close below yesterday's low point. Really bearish short-term sentiment, not able to bounce, and it's starting to fall. You can see no bullish peaks here, one little one, but no real significant bullish peaks on the near-term line. So starting to show some weakness and closing, potentially closing below the lowest point. Only this dividend, as well as some other bearishness here. This one-day sell-off that was quickly reversed. That's the only time that we were as low as we are now. over the past few months here, few expiration cycles. So a pretty significant bearish close that actually you can see has a lot of volume associated with it over the last couple of days. You can also see too from a long-term perspective, it is on a bearish death cross and is bouncing. Sorry about that. And is bouncing down from this 200-day moving average. The death cross, we had a return to the 200-day moving average, and now bouncing back down on 2 weeks, including today, and bouncing down from a falling 50-day moving average, below a falling 50-day. So bearish long-term pattern as well. If you take a look at like the Bollinger Bands, we're breaking down below a significant volume level, the volume level here. So in the last 2 days, we've really broken down below that. Not very much volume down below. You can see we do have an earnings coming up before that May expiration, so we don't take note of that. And you can see the DMI, indicators for Occidental. We're breaking above 25 on the negative line. We actually did that Friday, and today breaking below 20 on the positive line, falling. Red histogram here on the DMI oscillator, and at the down here bearish low point for the stochastic extreme. So bearish patterns on the DMI, and you can see a rising ADX suggests the potential that we're in this trend ready state where we can it can break up above 20 and make a run. In this case it would be a run to the downside. Let's take a look now at the options, and you can see right now 65 is all you got. You've got where the chart, you can see here's that 65 level, so it's basically getting back above that volume area on the Bollinger Bands would be that's where that 65 level is. Here, let's pull up the Bollinger Bands. So there's your volume level, so right above 65. So you got some significant resistance in that area. Remember, you also have an earnings coming up. So with that being said, you can sell the 65, buy the 67.5. You're already getting a pretty decent premium, even if you try to get in here at the expected price. You typically go for 58 cents on a $2.50 wide spread. That's a 30% return on risk, so you're getting a lot more than that. So what we can do here, and it's a relatively wide spread, so we'll go a little bit more. But if you say, okay, let me wait until I get 65 cents, yes, it's lower premium, but again, lower premium means higher probability, and that's what I want. I'd much rather have a higher probability of success. Then that means that this has to fall a little bit more, so another dollar, kind of make sure that we're going to continue to the downside before we get filled in, or at least the other way we get filled in, that price comes down is time passes. So that means we'd have to stay down here for a longer period of time. So again, it's just it's a way to make sure the stock is doing what we want it to do. It doesn't have to go down; it just has to stay down. Stay down below 65, and remember it's trading at 63.36. So that's how you can set that stop limit up. You can change it to a stop limit order, set it to GTC, and then let it go, and it will fill in on its own when it does what you want the stock to do, either fall or stay down here as time passes and the price time decay erodes that extrinsic value as well. Alright, so that wraps us up for today. As always, thank you very much for watching. Go to our forums. There's that link popping up there. And open a new thread. What questions or comments do you have for me about today's video? Or what questions or comments do you have that we didn't discuss, about something we didn't discuss in the video? You can be able to open a new thread and ask any question or make any comments. You can also reply to anybody else's questions or comments that you see in there. Remember, you have to subscribe to our site, though, to be able to participate in that forum, but you can do that for free. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, click that thumbs up, and comment on the video. Follow us on Twitter, join our community on Facebook. Have a great rest of your night, everybody, and we'll see you all tomorrow.